How should I factor in my pension to my retirement percentage? I contribute a percentage and so does my employer, but my actual pension payout will be based on the number of years employed and the 5 highest years of salary. What do you think?
Well, Brian, this is not an uncommon question that we get. How do you factor in? I think did you write about this in Millionaire Mission a little bit, talking about?
There's definitely some understanding what is net worth versus income statement, and pensions are promises. So that's why they don't make it on your net worth statement unless they actually offer you money at the end of each year as a lump sum. But even then, I think the way I would encourage people to think about this is from the cash flow promise perspective. And that's why what's really powerful as you get closer to retirement is knowing what your living expenses are going to be when you go into retirement. And then you use those pension promises to back away from that number to get kind of a net what money you will be needing from your portfolio and other sources of cash flow, whether it's Social Security and so forth. That's why I don't typically, unless there's a lump sum offer, I don't even put pensions on the net worth statement because they're more of promises than they are assets in some aspects.
What about when you're thinking about how to save, right? Like, so he says, I put some money in and my employer puts some money in, but it's going into this pension. Does that count against the 25% savings rate? Or how does he think about that from a retirement building standpoint?
I do think it could if it's a lucrative, but I'll also, it's going to create some homework because first of all, make sure it's covered by the Pension Benefit Guaranty Corporation. That's a pretty, most pensions are, a lot of pensions are, but you just at least need to go ask the question. And then you need to compare your benefits to what that protection is, because you don't want to have, like we saw with Delta employees, a few decades ago, where everybody's counting on getting pensions of like $150,000 to $180,000 a year. And then Delta decides, you know what, we have a big obligation that we can't afford to pay. And all of a sudden, all these pilots realize, oh my gosh, I'm not going to have that $150,000, $180,000 a year. It's going to be something much, much smaller. Or there's some settlement that's going to come out of this that's much, much smaller. So that's why you have to figure out how close you are to the protected level to even consider out if that's reasonable. Assuming it is, if you check those boxes and it's a reasonable pension that you'll receive that's well within the Pension Benefit Guaranty Corporation protections, then yeah, I think you can count that as part of your savings rate. But it doesn't mean that you, like if you're putting in 5 and your employer's putting in 10, because these pensions, sometimes they are funded like that.
Sure.
I still would strongly encourage you to try to find another, 15 to 20% of your own savings saving into the Roth IRA. It's basically following the financial order of operations so that you're making sure you're having money build up outside of that pension plan.
Yeah, the worst outcome that happens is you end up saving 25% of your gross income and you give yourself more flexibility, more options earlier on. A lot of pensions, you cannot begin taking them until you reach a certain age or certain stage. Well, you may decide, okay, I know I've got that money there, but I really want something to have in the interim. I want to have some sort of bridge. I want to be able to do something different sooner than I would be able to otherwise. So if you can do it without sacrificing too much presently today and without letting today's life pass you by, if you can get to 25% savings rate or near that, even with funding a pension, odds are you're going to get to choose what your financial life looks like much, much sooner.